All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the rally, the S&P hitting yet another major milestone. We'll discuss it with the investment committee. Joining me for the hour today, Steve Weiss, Jenny Harrington, Jim Lebenthal. We're all at post 9 as we check the markets. We're above 5,800 on the S&P. That's the milestone that I'm talking about today. Russell's leading, but we're having a nice broad move. Weiss, almost everything is looking pretty good today. Almost all the sectors out of the S&P. Bank earnings beat. PPI was cooler. What should we be thinking here as we end another week in this market?
Yeah, so look, everything seems to be pretty good. I mean, PPI is not as favorable, nor was CPI, that you're seeing this massive bull market pop that'll blow off the top. But it was just right. It was balanced. What it does do is I think that it pushes any thought of a 50 basis point decrease at the next meeting down to 25. But before we get there, we've got a lot of other ground to cover. What the bank earnings did, and they were very strong, and markets embraced them, of course, is it said, hey, the early signs are that we're going to have a good earnings season. The charge-offs for consumers just wasn't that big, even though they added to the reserves, but in total scheme. So everything seems to be working nicely with economic strength still there. So earnings season will be one thing, but the funny thing about earnings season is it gets us close to the election. So I question how muted even a great earnings season will be in light of the nervousness about the upcoming election. I couldn't tell you what the market's going to do if either candidate wins, because you just don't know.
Got to see how, Congress shakes out. Obviously, that's what people are talking about.
Even the bullish, even forget about no politics, but whether you're for Trump or whether you're for Harris, everybody wants to see a divided Congress.
Right. Good. Right. Gridlock's, the old saying, gridlock good for the market. All right, Jenny. So Tony Pasquarello, Goldman, every Friday comes out. The flow of capital tips the scales in favor of the bulls. I don't think anybody's really arguing with that, right? Yep. Price action suggests it's a market that continues to be bought. Keep your eye on the ball. He's been saying that consistently and consistently correct. Keep your eye on the ball through a noisy month. We expect it to be a noisy month because of what Steve said. Again, distill it all down, clear out the noise, and this is a market that obviously wants to go higher.
I think it does, and I think what's going to be interesting and what will come out of earnings is who's going higher. And will we see a continuation of the third quarter where there was actually like the laggards from the previous part of the year started to lead and the leaders actually lagged? Only earnings is going to tell us which side continues, right? Is it going to be the first half leaders who continue into the fourth quarter, or is it going to be the laggers who get steam? And I think it's going to have a lot to do with earnings. So where I sit this week is, I too am very unsure. And I was saying earlier, I feel like I'm a little bit in no man's land this week, and I just need to sit here and kind of twiddle my thumbs and wait for earnings next week and wait for economic data next week. I don't really want to make any big bets until I see what the numbers really look like, which is an uncomfortable place to be. I like knowing, I like doing things, I have a bunch of cash, I want to buy things, but I'm uncomfortable.
I mean, we're just starting earnings season. Are you going to wait until the end of earnings season to assess how it all went?
No, but for example, right, I'm looking at 2 BDCs to buy, and they're announcing earnings on the 30th and on the 5th. And I'm comfortable waiting until those days and seeing what they say in their respective earnings to figure out which one of those two I want to buy.
So, Jimmy, the direction of travel still feels to the upside from here. Barclays saying that today. They were echoing, the kind of conversation that we're having. BTIG's Jonathan Krinsky. It's difficult to have any sort of meaningful bearish posture. Look, he has read the markets at times and said it was, portending maybe something a little more cautious than not. But I mean, even people who have been looking for reasons to think that maybe this was running out of steam are stepping to the side.
Yeah, I think it's, and I'm just going to go with where Krinsky was, it's hard to find a reason to sell here. If you want to say that maybe the Fed's not even going to cut it all in November, I mean, that's reasonable. There's a possibility of that. However, think about why they wouldn't be cutting. It's because the economy is strong, and with it, good consumer strength and probably good profits as well. If you're going to say that the valuation of the market is a reason to sell, you're going to be flat out wrong. You're just going to flat out be wrong. It's not that valuation doesn't matter. It doesn't matter in the fourth quarter of this year when you've had as much gains as you've had. Nobody's going to want to take taxable gains if you're a taxable investor, and any professional manager doesn't want to fall behind this market. You know, the one thing I will say in response to what Steve and Jenny just said is I hear your discomfort, Jenny, but I would think that the earnings season has actually been set up in a classical pattern to do well. We've seen estimates come down across the board for 3 months, and usually that is a setup. That's the under-promise, over-deliver that happens unless there's a bad economy, which there just is no sign of.
So let's discuss, when people say it's difficult to have any sort of meaningful bearish posture, you still hear some bearish narratives from people. Oh, valuation's historically rich. You're at S&P's at 21.5 times. The 10-year average is 18 times. We know that we're historically expensive. The issue is, though, that earnings are expected to live up to the hype and rates are expected to come down. Now, even yields, if they stay up, they're up not because inflation is re-accelerating, it's because the economy's good. Yields are going up for the right reason, right? The Fed is still on track, Weiss, to ease. Well, but they're going to do it at a slower pace. Okay, so what? The economy's good. Like Ed Yardeni yesterday, I know it's an outlier view. He said there's one and done. He didn't think they should have gone 50, and now he doesn't think they're going to go any more this year. Now, again, it's the outlier view. Market's banking that you'll get a couple more rate cuts, but you know, the market doesn't need the cuts, I think, as much as we once thought, or the market itself thought it did.
Yeah, you know, it's very accurate what you say. The most troubling thing about what you said and what you're saying is that it's difficult to find the bearish case. So when it's so difficult to find the bearish case, that means sentiment is at an extremely high level of bullishness.
You feel like we're there? You feel like there's too many people?
I think we are there in terms of the bullishness, without a doubt. I mean, I'd be hard-pressed to find anybody that isn't bullish on the market. In terms of strategists, economists, people I talk to, you know, they're a little more measured in their approach.
Sometimes the consensus is correct.
Oh, absolutely, and that's been the consensus, and it's been correct. So, you know, I've raised some cash, only because the positions I've raised that cash from were really significantly outsized because I bought them when they were dislocated in the market.
Why'd you make that sound when I said sometimes the consensus is correct? I mean, the people who've been trying to throw cold water on this rally have for the past 2 years, right? Well, tomorrow we mark tomorrow's Saturday, we mark the 2-year anniversary of this bull market.
Right.
I've heard a lot of, along the way up,
it's because
well, this could happen, or what if that happens? And those people have missed out and they've underperformed.
Right, but what we know is the pendulum always swings too far. So then when we read the data that you have here, like capital flows tip the scales in favor of the bull, we know how much capital has poured into the equity markets, and that gives me pause in the same way, because we know it always gets too frothy on both ends. It's why bear markets are amazing breeding grounds for great investments, and it's why the bull market always goes a little past where it should. So that's just why, because consensus, you know, it's the herd mentality.
Yeah, but there's a lot of areas of the market where a lot of money has not flowed into.
Yeah,
that sort of helps what some are trying to make is a continued bullish case, just away from the areas of the market that look to be, you know, more expensive than others. I'd love your takes on what I thought what Ricky Sandler of Eminence posted yesterday on social media late in the afternoon, which I did reference on the closing bell rather extensively, I thought was an interesting spot to have a conversation around. He says the market at the index level is expensive and consensus. It's exactly what we're talking about. And we know the stocks that he's alluding to when he says that, because he says the biggest tech companies have a blend of overlapping competition and rising capex, and outside of Amazon feel uninteresting to me. Yet the macro backdrop is favorable, with a resilient economy and the Fed on your side. You take those two together. He says the combination of 1 and 2 means you can and should play offense in the vast array of below mega cap companies that have interesting equity stories.
Well, look, Ricky's done a great job for the decades he's been in business, but reasonable people can disagree, and he's not positioned in those names. I don't know that he has been, but from my standpoint, that's where the value is. You know, with the cash I've raised, I want to put it to work, but I'm having trouble finding places to put it to work.
Well, let me give you an idea.
I think I'll let you
give us an idea.
Okay.
Give us an idea.
So Kinder Morgan, for example, which is the largest midstream energy company in the S&P 500.
I think I saw a call on that today.
I know.
Keep talking. No, keep going.
Okay.
keep going. I'm going to look it up and I'm going to bring it up.
So dive down into Kinder. They have 79,000 miles of pipeline, right, that transports natural gas and refined products. They have storage terminals. They're just integral to the U.S. economy, and they benefit from a strong U.S. economy. They've done a tremendous amount of investment. The stock's kind of been flat. They pumped out a dividend yield, but where they are now is at a turning point with all that investment they've made. So if you look at their earnings from here, their earnings are growing about 9% next year, 11% the year after that. Stock's trading at 18 times next year's earnings, 16 times the year after that. And you've got this lovely combination of earnings growth, a multiple far more reasonable than the broader market. You've got a 5% dividend yield on it. That, to me, is an interesting place to play. And by the way, they're a direct beneficiary of economic growth, and they haven't participated in the frothy part of the market. So I really think you're right, Scott. The market can go higher, but I really think it seems more likely to me that it's led by.
What's the market cap of Kinder Morgan? Let's put it up, and I'll mention the upgrade that we were alluding to. Upgraded to buy from neutral, Bank of America.
Market cap is $52 billion.
Okay, so $52 billion. Ricky goes on to say, as I mentioned only the first line of what he was talking about the stocks he finds attractive. I'm neutral on the S&P, but believe the mid to large cap world, 2 to 50 billion. I'll put this in. I'll let that in. Okay, 52 billion. And quality companies, he thinks outside the U.S. could materially outperform the S&P over the next 1 to 3 years. So I mean, if you get away from the 3 trillion and the 2 trillion and the $1 trillion market cap companies, people like Ricky say there's a lot of opportunity out there. You just cited one.
And I think so. And I think this is where I'm struggling too, which is I don't see any reason why the market shouldn't end the year in positive territory. I also think it's hard to sustain this trajectory and have another kind of roughly 8% growth between now and year end. But when I look out past this year, I look back, so I need to look out past this year and I look back. When I look back, you know what the market's returned over the past 10 years? It's had a 13% return over the past 10 years, 14%, and a 16% return over the past 5 years on an annualized basis. I look at that and I think, okay, a lot of growth has been pulled forward. That's why we're trading at a pretty rich multiple of 21 times. A lot of AI hype has been pulled forward. So when I look out, I still see equities as the best asset class out there. I still see growth ahead. I just think it's going to be at a very different level. I don't think we're going to hit that annualized 14 and 16% return. So when I look out at that, I'd rather own a Kinder Morgan going into the next several years where there's really, really highly certain economic, resilient earnings growth ahead with a reasonable multiple, with a nice, juicy dividend yield. That, to me, is compelling. And there's not tons of it out there, but there's enough of it out there.
First of all, I'd say in Kinder Morgan, I don't play energy. I found energy to be more like trades.
Yeah, this is representative of the fact that there are other names out there.
No, and I agree.
That may be advantageous for people to take a look at.
Right, and the juice will be, in terms of outperformance, very possibly in the small mid-cap area. And I do have some exposure. I have Leidos. I've got QXO. I've got GXO, which we'll talk about. So I'm not, missing that completely. But a lot of those have also moved up because of that narrative. So I think that you're not, that you're paying a little bit for a much improving economy versus stable economy. In terms of Kinder Morgan, it's been integral to the U.S. economy since it's been around for those very reasons. And what you can't confuse or conflate the market of certain sectors with the overall market indices. So the mega cap tech, because of their growth, because of their balance sheets, and because they do invest for the future, deserve that higher multiple.
And that's why they already have the higher multiple.
But it can go higher. But energy companies, on the other hand, are highly cyclical and not in control of their own fate for the most part. They may be for the duration of take-or-pay contracts, which we see fading. They're not so much anymore, but overall.
I've been staying out of this, but before we dive into the energy factor, the reason I've been staying out of it is because you guys have been singing the tune that I've been saying for quite some time about broadening, and I'm just quietly, happily hearing you guys say the same thing. The market's been saying it for a while, too. And I don't think it's over. And, Scott, this is to the point regarding Ricky Sandler. I think he's dead on. okay? It's not over. I will admit that for the last year, whether it's small caps, whether it's value cyclicals, there's been this starting and stopping cycle. But it's clear that it's got momentum now, and it's got momentum for fundamental reasons. A strong economy, which begets financials, it begets industrials. And there's momentum to these names as well. You put that with the valuations that whatever the discussion is, whether Microsoft should trade at 30 times, whether that's expensive or not, you don't have that discussion when you're talking about financials at 10 times or at book value. When you're talking at healthcare with a 3% dividend yield and mid-teens multiples, or energies, notwithstanding your comment, Steve, which is arguable, that's why there's a market for them, but these stocks generally trade at low-teen multiples with 3 to 4% dividend yields. There's reasons that the rotation should continue and the broadening should continue.
You think that we're going to get a continuation of this broadening market that we had in the third quarter? You know, over the last month, not even full month, but a few weeks, technology sort of reasserted itself. But I think the further along the train tracks of soft landing you get, you're probably going to have more belief in the fact that other areas of this market can continue to work. Now, maybe the bank earnings today and some of the commentary would suggest to you that that's happening. If you look at the Russell, for example, which is leading by a lot today, you know, 2,200 is where that index has been sitting. You need to get some further level of confidence to have a greater belief in that trade overall. I've had people, you know, contact me, some money managers that you know, who are like, look, I bought the Russell and I bought calls into early next year on the Russell because they believe that this story is intact and it's only going to continue to get better.
No, I do believe that's where it's going to go. And, you know, I've actually looked at buying the Russell, buying calls on as well, just haven't pulled the trigger yet. Been waiting for maybe this earnings period where everything doesn't show up as rosy, particularly in the financial stocks. But I think you have to be selective. But let's not kid ourselves in terms of the market, the people that are in the market being so smart. They're buying indices, which, by the way, has been the smart thing to do because it's easy and they perform quite well. I mean, there's nothing to be ashamed of with a 21% return in the S&P. So that lifts all boats, right? So if you want to get in the market, and the market is dominated, the market is dominated by index funds, right? More than 50% of every single stock out there, number one, and by relative value players. So when they put that into their calculations, they say, okay, what has been the long-term valuation of the Russell versus what's been the long-term valuation, and they pick various periods of the S&P or the NASDAQ, and that will drive the indices up. So that's really what's driving it most.
Steve, there's an important follow-on point to what you're making. I am bullish. We know this about small caps, industrial cyclicals. But what you just said is a reason why you shouldn't be selling your Microsoft, your Apples, your Amazons, regardless of what you feel about it. The money that flows into passive ETFs, we know the biggest ones are the Qs and the spiders, right? That goes to all of those mega cap stocks, and it's going to propel them higher. Now, I happen to think that the rest of the market will catch up, but I'll tell you, if you're overweight like I am, cyclicals, and you have a healthy tech exposure, it means you're underweight something. What am I underweight? REITs, utilities, staples, those they bore me.
Are you're overweight small cap stocks?
I have the IJR, the small cap 600, as a position in my portfolio.
But that's the only way you're really expressing your view?
I have,
like what?
I have Casey's, and I'm drawing a blank on what the other one is. I'll come back to you on that.
Can I ask Jim a question? So, okay, so you said, here's reasons not to sell your Microsoft, your NVIDIA, your big caps. Okay, I agree with you.
Yes.
But you know what we're coming up on? We're coming up on year end where people are going to get bonuses. So, Jim, when your clients are coming in and they say, hey, I have fresh cash, right? What are you doing? Where are you putting it come January? Because a nice way to reduce your exposure to those stocks, you don't have to sell them. You can reduce them by reducing the denominator, right?
This is a good question. Here's my answer. You take it or leave it, okay? Here's my answer. I'm not going to worry about January just yet. What I am telling you, and I've said this many times over the last couple of weeks, is I think the fourth quarter will be strong. I think there's just a flat-out absence of sellers, okay? Start there. Now, you asked the question, what do you do in January? Normally, when you have a year like this, it it crescendos into the first part of the new year. Normally, maybe it's the bonuses. Maybe people say, hey, the momentum's good. Why should I sell now? But what I'd like to say is, let's just get through the fourth quarter before we worry about January.
Let me ask you this. Let's kick the banks around for a minute before we take a break, just simply because we did start our show by telling you that the earnings were good. You've had Goldman hitting a new record today, Morgan Stanley hitting a new record today. You can see the performance of the sector overall. How do you want to view these here?
Yeah, look, I think that despite the dire commentary from Jamie Dimon, which we always get, and I'd rather
always does.
which we always get, as I say, and I'd rather have him that way than hype his company like Elon Musk. We've seen that credit quality remains, pretty good, despite consumer balance sheets and consumer lending being again at a new high. So that's very encouraging. What I found particularly encouraging for Goldman, which is, a very large position for me, is in banking and trading. So you don't have to worry about that credit quality from retail anymore because they've written down those businesses or sold them. So to me, I'm not surprised that Goldman's up. I'm not surprised that Morgan Stanley's up, because if you take the sweetest part of what those reports were, it goes directly to those two companies.
You have JPM?
I have JP Morgan and Citi and BlackRock, and I'm very happy with what I'm seeing because it's a validation of what the economy is showing us, which is basically people are employed. I'll stop. People are employed. Oh, I'll go a little further. Average hourly earnings is increasing higher than the rate of inflation, so they have more money to spend. That means credit quality, I think you just mentioned this, Steve, or maybe you did, Scott, is better than expected. Relative to Jamie Dimon's comments, relative to what he normally said, I thought it was a Boolean. Frankly, I mean, for him to say the consumer's in good shape, relative to what he normally says, absolutely. But again, to what I said earlier, you take a look at these stocks. I don't care if it's Goldman, JP Morgan, Citigroup, Bank of America. These stocks are trading at low-teen multiples, good dividend yields. But some of them trade at a premium to book value. Not all of them. But with the fundamentals of the economy intact, it's not just trading. It's underwriting should creep up. And when we talk about underwriting, people usually think IPOs. No. It is the debt markets that is powering capital markets. It's debt issuance. You've got wealth management.
Long-term valuation of the bank stocks, you'll see low teens multiples are appropriate for those companies. So that's actually not a flashpoint say buy.
I can find ones that are trading at 9 times. Look, Citigroup's trading at 9 times forward earnings. You tell me what to do with that.
Here's the thing. You take that and you say, okay, let's say they maintain that mid-teens, that 9 times, that 11 times, that 13 times. But you know what? They're growing at 6%, 13%, 12% next year, same the year after that. So if they maintain a flat multiple and just grow along with their earnings, you've got mid-teens earnings growth coming from all of them. And I think that's kind of mathematically achievable. To me, those estimates are no one going out on a limb, being super aggressive or creative. So again, going back to who's going to lead, like if I think I have a pretty flat market next year or a pretty lackluster market compared to the past, and I think these guys are going to grow in line with their earnings growth of 12 to 13%, fantastic. Banks look good to me.
You look at what these stocks have done, you still would make the argument that they're cheap?
Yes.
I mean, JP Morgan's up 31% year to date. Your Citigroup's up 28%. Goldman's up 33%. Bank of America's up near 25%. Presumably, the multiples have gone up a bit from where they were at the beginning of the year. So, they're trading at higher valuations. They've already had tremendous price appreciations. So how do you make the argument today that they're still so cheap, like you clearly were?
Yeah. Well, I don't want to be accused of cherry picking. I mean, Citigroup's
I just gave you five names. What's the cherry pick? I gave you five names.
If we're having a valuation discussion, as I just said, it's 9 times forward earnings, but probably more to the point, it's 70% of tangible book value.
But I've heard that argument now for years that the banks are trading, this bank and that bank and the other bank are trading at a significant below tangible book value. That in and of itself is not an accelerator necessarily for what a stock price is going to do.
I submit to you that Citigroup's performance this year and over the last 12 months is absolutely this inanity, my word, of it trading at a discount to tangible book value being corrected. And I think it's going to continue. That's why I'm long the stock. That's why, to answer your question, despite the fact that it's had these returns, I absolutely think this is a buy right here. Now, I will draw a distinction. BlackRock has had a fabulous run. I'm not selling a share, but it gets a little harder to buy BlackRock after the run it's had. You do have to pick stocks here. Your point is made. You just have to reflect it in how you pick stocks.
I just go back, we've been hearing on this program at minimum for 5 years from people. I'm not suggesting, I'm not suggesting that they're not good stocks, but I feel like the argument for our viewers to, continue to buy these because they're trading below their tangible book value is not necessarily good enough.
Well, JP Morgan's almost at 2 times its book value. So, you've got Citi at 60% of book value.
Take Bank of America at 1.2.
Hold on, let me finish. But the PE is the same on Citi as it is on JP Morgan, right? So that's a little bizarre.
Actually, no, but keep going. I want to hear where you're going.
It's pretty close. It's within one turn.
12 versus 9. But go ahead.
Well, that's not what I show. But in any event, you get the point. So I'd say that it's still a quality issue. Citi still has to play out. Because while Jane's made some great changes, and we've seen them grab a little bit, I'm with you. I think they will. But I've got enough bank exposure. Now, B of A is also cheaper. But B of A is not the pure play that a Goldman is, right? Because it has a massive consumer credit card business. It's got a massive commercial business. So it's a different kind of play. And I own some B of A, but not nearly as much.
Do you own Citi? Have you done that yet? What do I got to do here?
You probably have to sell it.
All right, coming up, hitting the skids, Tesla is tumbling its robotaxi debut, failing to impress. Halftime committee member Bryn Talkington, she's in that trade, as you know. She's going to join us, tell us what she thinks is ahead for that stock next. All right, welcome back. This is a really interesting story for 2 stocks. So Uber is, I think, the best performer at the S&P today. Okay, it's up near 10%. The bookend is Tesla, which is down near 8%. That's after the robotaxi event failed to impress many. I'll give you some of the commentary here. Adam Jonas, Morgan Stanley, that's it? Disappointing lack of detail. Tony Sacconaghi, Bernstein, overall, we found it underwhelming, stunningly absent on detail. Wells Fargo, most razzle-dazzle, little substance. And that, frankly, seems to be the biggest takeaway. All style, out in L.A., and little substance. And it's clearly taking a toll on the stock and giving Uber a nice boost. Let's bring in Bryn Talkington. She owns the stock, Tesla, that is. We'll talk Uber in a minute. So, Bryn, give us your read here, because this seems to be, if not universal, certainly the majority of observers who judge this company's stock say, meh, that's it?
Yeah, I think so. To take a step back, from the beginning of August to the end of September, I think Tesla stock was up close to 40%, really on no news, no real fundamental news. And so I think there was so much hype around this. And I think one of the common words that you're using from a Tony or a Jonas is lack of details. And I think when you have a $700 billion company, you have to manage the short term with the long-term innovation. And so I watched it. I thought innovation is alive and well. I thought the Optimus was incredible. And if you remember 2 years ago, I think it was 2 years ago at their investor day, they actually had a person in the Optimus suit dancing around. And now they actually have these robots walking around. And I know they're also working in some of the facilities on a limited basis. So I get while it's down today, it was up 40% over the last 2 months. It was short on details, but I think for a $700 billion company that's still innovating, I think we will get details on October 23rd during their earnings call.
Yeah, Dan Ives, he says, we strongly disagree with the notion that last night was a disappointment, as we would argue the opposite. Seeing Cybercab with our own eyes and the massive improvements in Optimus, which we interacted with throughout the evening. William Blair calls it, Bryn, the most impressive event to date, but little near-term impact. And maybe that's what's most representative in a disappointing stock performance.
Yeah, I would agree, right? I think, but once again, for investors, the way I'm looking at it right now, I sell calls against the position, so I closed those out today. I bought them back. The stock has support, really strong support around 198.205, which is still quite a bit lower. But on October 23rd, remember, that's earnings. I think they will talk about the cheaper car. I think they will talk about full self-driving and how that's going. And don't forget, it came out earlier this week in China. Their China sales, September year over year, were up close to 20%. And so I think this is a good, healthy pullback, but I think we're going to get details when it comes to earnings in a couple weeks.
All right, I appreciate you, Bryn. Thanks for coming on, talking about this, Bryn Talkington. Jenny, we said about Uber is rallying. Josh Brown, obviously has a huge position in Uber, and he posted Quote, the big winner from last night's launch is Uber. I own it, which all of you know. He's just making a full disclosure there. But Elon announcing a, quote, Uber killer was the bear case for that stock. And last night that went away.
Yeah, I think it's weird that it was ever kind of positioned as an Uber killer because that never seemed reasonable. I don't know if many of you read this too, but I read the Elon Musk biography by Walter Isaacson, which is a phenomenal read. But what you see is, and he said it in the thing too, he's like, look, I'm bad with time frames. Like, forgive me. He is bad with time frames. And what that means is the net present value of the future dollars is lower today if you receive them in the future. So the Uber killer, really, that never made sense to me. The fact that this was hugely competitive in the near term doesn't make sense. Uber is doing something extraordinary. And by the way, they're partnering with Waymo too, so that when you're going to book Waymos in Atlanta and in Austin, you're going to do it through the Uber app. I wonder if that's a better method for the robo-less taxis. It's kind of the same as, if you order an Uber now, you don't really care if a Toyota or a Honda shows up to pick you up. If you order a autonomous driving vehicle in the future, do you really care if it's a Waymo or a Tesla that comes and picks you up? I don't. I just want to get from point A to point B.
You order a Waymo in San Francisco, and in most cases, a Jag shows up.
Okay, that is cool. I'll give you that. That's cool.
I rode in a few of them.
But it remains to be seen if you can make money in robo-taxis.
It does remain to be
With
seen.
Uber, you've got the driver footing the bill for the insurance, for the auto maintenance, for the gas or the charging. With the robo-taxis, it's the company footing the bill. Waymo doesn't make money. It's unclear when they will make money, and they're the leader in the industry.
Right, here's the bottom line, is Uber has the proven technology today. They're growing their earnings by 100% this year, 42% next year. They have a 4.5% free cash flow yield, trades at 38 times, but it's there. Like, they're cranking out the dollars today, and for the foreseeable future, which is like several years, like that's what I want to own. I want to own that technology. I want to own that cash flow stream.
Coming up next, our calls of the day. A fresh all-time high for one stock, gearing up for earnings next week. One firms up the price target, too, ahead of the print. We'll debate it next. All right, we're back. Let's do calls of the day. We're going to start with Netflix. And Weiss, we have many calls on Netflix this week.
Yeah, it's crazy.
Sometimes, twice a day. Most have been bullish. And that's what you're getting today. Guggenheim reiterates buy. They raised the price target to $810. Jefferies goes to $780. I don't need to read all the bullish stuff here because the points are clear. I mean, they think the stock's going considerably higher. What do you think? It's a record intraday high again today, by the way. 5 straight weeks.
Yeah, I will tell you, it's still an uncomfortably large position, but I'm getting paid for it. Clearly, the sense is that it's going to be a great quarter. You're going to see subscriber growth. Let's not forget.
Next week.
Next week. They continue to have great flexibility in terms of the ability to raise prices. And as I pointed out before, other streaming services have been creating that pricing umbrella for them by raising their prices. So I continue to like it. Unfortunately, it ratchets up the risk of missing the quarter. I generally don't care about quarter-to-quarter performance. I use it as an opportunity to buy and sometimes to shave off. But yeah, to me, they're the only real game in town, the only pure play, and I continue to like it. It's, I would say that it's not cheap, but for scarcity and for the growth and for just an incredible management team, it's worth what you're paying for it, for sure.
Yeah, I mean, it's interesting. I think, I recall a call on this name, whether it was last week, at the beginning of this, at $700. There was a negative call saying, all right, maybe that, this stock's gone too far at 700, and here we are. It just keeps blowing up at 725. So we did Kinder Morgan. I'm not going to do that one again.
Let me just be full disclosure.
Yeah.
As you may recall, I did sell some of it because I bought this really large trading position on their last miss. I sold some at about 711, 712 weeks ago at this point, but still uncomfortably large.
Okay. All right. So Kinder Morgan was upgraded today. We did mention that earlier in the context of a stock that, Jenny thought was a standout. AbbVie and Regeneron reiterated overweight Morgan Stanley. Regeneron price target to $1,235. Obviously bullish, and AbbVie, they're bullish there too.
So I'll take Regeneron first, and then I think you've got AbbVie.
Jimmy's got AbbVie, you have Regeneron.
So remember in the beginning when I was saying, hey, maybe the market's gone too far. Well, maybe this has gone too far. And I always want to be in a stock before anyone else is, and I want to be out when too many people are getting in. So while I appreciate Morgan Stanley's reiterative overweight and their upgrade of the price target, here's the reality. We bought this 3 years ago. We're up 120% on the stock. Where it stands today is there's 8% earnings growth this year, in 25, 13% the year after that, and it trades at 21 times. So it's really priced a lot of the great news and a lot of the great things that have happened in. One of the things that Morgan Stanley's talking about is how their EYLEA sales, which are the injections for the wet macular degeneration, how those are going to be a little better than expected. Fantastic. Guess why we bought it 3 years ago? Because we expected that. So where we stand right now is we're really debating, do we reduce our position? Do we sell our position? It's pretty close to fairly value.
Very quick, Jimmy, on AbbVie.
It's a heroic stock. You can look at the long-term track record of price returns, but the reason why it's got those price returns is great management. Management had a problem with Humira. It was coming off patent. They solved that with two things. One, Skyrizi and Rinvoq from their in-house pipeline, and then they bought companies like Cerevel, which has a great schizophrenia product that's on the market or coming to market soon. Management has done a good job. At 16 times forward earnings, you can buy this right here.
All right, Mike Santoli's next with his midday word. Senior markets commentator Mike Santoli's with us now for his midday word. I guess the word is earnings.
Yes.
And, financials are leading for a reason today.
They are. So it's a pretty linear response. I mean, sometimes you get the next batch of bank earnings and you have a little bit of a spillback because we kind of knew what the broader trends were and got it priced in. But that being said, in general, looks like the bar is pretty low heading into earnings season. A lot of people have been talking about how dramatically numbers have been cut. It seems like we were working off of that July-August slowdown fear, and that kind of came through into the final numbers. I think that's all to the good. Hard to find direct fault with anything the market's been doing here. You do have mostly cyclical leadership. Credit's rock solid, even though the volatility index is higher. A lot of people pointing to that. It's really more about where the trend has brought us to. I know 5,800 in the S&P actually was a target of a lot of these sort of trend technical models. If you go back a few months, doesn't mean it's over, but we are getting toward the upper end of this sort of advancing band, just technically.
Yeah. Financials generally don't give you the greatest tell for earnings season, but it certainly is better to get off to a good start because a lot of times these stocks don't.
No, that's right. And again, let's see, when we hear from Citi and you hear from the rest of it. But I think it's right that in general, the message they're sending about the credit condition of consumers in particular is probably one that people will lean on as we go through the earnings season.
All right, I'll see you on Closing Bell. That's Mike Santoli, our senior markets commentator. Straight up, we'll get you set up for next week. We do have some key committee names that are reporting. There's the board. It's starting to get full. We're back in 2. All right, the setup for key earnings next week, Tuesday, United Health, Jimmy.
Yeah, so I've said earlier in the show, we have to be stock pickers, Scott. We have to choose what to buy, sell, and hold. Right now, this is a hold. This is a stock that has done very well recently, but it's in a challenged space with medical loss ratios creeping up and Medicare reimbursements coming down. At 19 times earnings, I think it's fairly priced. Now, I don't want to sell it because it is the category killer in terms of health insurers. But this is not, Jenny, to your question earlier, where I'm going to put new money right now.
Okay, Wednesday, SL Green. You sold that.
Right.
Right?
I sold it at around 66. It's at 68 now, so I left a couple bucks on the table.
You really liked it.
I loved it. And it did everything and more that I could ever hope for. It's up 92% over the last year, over 50% this year. And I think this is one where all the good news has been pulled forward. I cannot imagine what they're going to say next week that could drive the stock significantly higher. So, well, it's wonderful, and I hated needing to realize that capital gain. I wanted to repurpose the money. It's down to a 4.5% dividend yield, and I thought I could do better elsewhere.
Weiss, Thursday, Taiwan Semi.
Look, I don't expect anything but a really strong quarter. They give you monthly numbers pretty much, so I think it's going to continue to perform as well as it has. And you can't get enough capacity, no matter who you are, whether you're NVIDIA or pick another, tech company that outsources their fabs. They just can't get the capacity.
All right, American Express, Jenny, a week from today.
So Amex is twofold for the way I'm going to look at it. One is trading at 20 times earnings, which is actually getting rich. Now, this thing totally deserves a premium multiple to all the banks. It's got really consistent mid-teens earnings growth ahead. But the divide between that multiple and the earnings growth is starting to get a little, squishy for me. I liked it a lot better at 18 times, which was just a few months ago. What's going to be the most interesting, one other thing on that. They're a machine. They deliver. They execute brilliantly and consistently. What's going to be much more interesting is how they talk about the consumer, how they talk about business spending, what their delinquency rates are. That's what I'm really looking for on this call.
You guys haven't really thought about anything good today. I'm kind of depressed.
I mean, I could
about
call
that.
it something.
I was talking about you.
You can't force
Talk about
it.
these guys.
It's got to be.
Let me see if I can. We got to go to break. I'm gonna try and come up with something in the break.
I'm
We're back after
I'm
this.
letting the viewing
I feel like
decide in their own.
I feel like we've let people down. Let me down.
Scott, I feel like you're the main instigator. I mean, where should responsibility lie?
We're back after this. An exciting week ahead. Want to tell you about on Tuesday. We're going to be out in Los Angeles for the Case Alternatives Conference as we look at investment opportunities beyond stocks and bonds. We're going to talk private equity, private credit. We'll talk about sports as an asset class, and we'll do it with some of the best names and the biggest ones in alts right now. We have an exclusive with Todd Bowley. We can't wait for that. Eldridge Industries, of course, the chairman and CEO. It's been a year since we've sat down with him, so we're looking forward to doing that. Matt Brown of Case, the chairman and CEO. That's the platform that basically connects institutional investors in alts with wealth managers so that you can invest in things beyond stocks and bonds. The Zinnia CEO, Ian Charles of Arctos, it'll be his first TV interview ever. They've made such a huge play in sports investing. We'll do that as well. John Taft of Baird will join us, and we can't wait. Tom Lee on Closing Bell, Loretta Mester, the former Cleveland Fed president. Final trade. That's today.
Delta Airlines.
Cisco SYY.
GXO, I've been adding to it. I think the company's worth about $80 a share, and then it will be acquired.
All right, good stuff. I'll see you on the bell.